What is up, traders? Hope everybody's doing well. Today's lecture is going to be about breakaway gaps, what they are, how to use them, how to identify them, all that good stuff. So, a breakaway gap. What is the breakaway gap? A breakaway gap is basically the first clear fair value gap that breaks structure either to the upside or the downside after a consolidation. What do I mean by that? Let's look at this example. This is from my journal, which I told you guys about earlier. To journal trades, so you can go back to and gain knowledge, see your mistakes, see what you did good, right, see what works and all that. See, here today I'm benefiting from my journal by teaching you guys and showing you guys examples of me taking trades. This one included a breakaway gap. So let's get into it. So if you look at this portion here, obviously I haven't noted what a breakaway gap is, right? So if you look at this fair value gap, what makes it unique, let's say, over this one? Or is there anyone else like this one, right? What makes it unique? Why is this called a breakaway gap? If we see this range from here to here, this is just a consolidation, right? Price really wasn't going anywhere. It was, yes, trailing up here, then broke structure here, but it was kind of in this like not going anywhere range for a while. And then out of nowhere, we did have this fair value gap. But it didn't really break away from the range clearly, right? If we look at this fair value gap, look at what it did. It broke structure to the downside very clearly, right? It was the first clear fair value gap, very noticeable on the chart. It broke structure to the downside very heavily after a consolidation, right? So what happens is when you have a breakaway, now you don't know if this is a breakaway gap or not, but you assume that it is, okay? So since I'm assuming that this is a breakaway gap because of my knowledge, it broke structure to the downside. It's a gap after a consolidation. So my knowledge, I'm assuming that this is a breakaway gap. So what applies to a breakaway gap is generally, if you're heavy on side, you don't want to see price trade into it, or if anything, you want to see it trade just barely into it. You want to see the upper half remain unfilled. You want to see it optimally not trade into it at all, or just barely trade into it and then drop immediately, which is called an institutional order entry drill, right? Institutional order entry drill, okay? So a breakaway gap, since I have this knowledge, right, when this happened, I'm assuming that this is a breakaway gap. So I'm going to have to accustom my entry if I'm going short according to it, right? So in this case, what I did was we saw price push down, and inverse this shaded area. What this is the 930 fair value gap, which I just talked about in the previous lecture, okay? So what I did was I have now an inverse 930 fair value gap, right? And I have a breakaway gap. A breakaway gap, which is discussed, we don't want to see price trade into optimally, or if it does trade into it, barely trade into it, leave the upper half unfilled, and then completely drop. So on this case, what is the most optimal entry for me? Is the most optimal entry for me to put my entry at the fair value gap? Of course not, since it is permissible for it to barely trade into it and drop, but most likely I don't want it to drop. I don't want it to push into it and drop. So my logical optimal entry now in this case, since here I have an inverse 930, I'll put my entry at that inverse, and I'll put my stop loss to accustom the breakaway gap just in case price does want to trade into it. Okay, I don't demand that price does anything. But with a breakaway gap, since I'm assuming this is a breakaway gap, I want to custom for my entry and my stop loss. I'm not entering at that fair value gap because I'm assuming it's a breakaway gap and I don't want to see price trade into it. So optimally, I'm going to look for another entry. If I had another fair value gap here, I'll look to enter on this fair value gap. But since I have the inverse fair value gap, I'll enter off of this, right? But my stop loss also has to accustom to the breakaway gap. Since it can trade into it, then I'm not going to place my stop loss right at it. I'm going to place my stop loss where it is not forbidden, but most likely, since we're working with probabilities, since this is a breakaway gap, most likely it won't trade to it, which is the upper half. So I'll put my stop loss within the upper half, which you can see right here. So entry was on a different PD array, which is in this case the non-30 fair value gap. It was inversed. Obviously, there's a specific time of day. If you look, this is probably during the 9:50, 10:10 macro, or 9:50, 9:45, 10:15 macro. You can see the time right here. It's just right after 10. And then the inverse 9:30, stop loss right above the midpoint of this breakaway gap. Take profit was at London lows, which was session lows. We discussed that in earlier session lectures. Right? So this is basically how you trade and treat a breakaway gap and how to identify it. I'm going to go over another example right now. All right, example number 2. Same thing. If you look here, we have a very clear consolidation. Price was just absolutely going nowhere. And then out of nowhere, we have a displacement lower that broke structure, and it's after a consolidation. We have, if you look, this is very nice. We have 2 fair value gaps here. We have this first one. We have this second one, right? A breakaway gap can only be one fair value gap. Unless we have a volume imbalance, then we include the whole thing, but it's one fair value gap, okay? So we have a consolidation, a clear break of structure here. We have 2 fair value gaps. Which one is the first fair value gap? It's this one, right? So this is a breakaway gap, whereas this one, price can trade into it. And we can see here how price very nicely did trade into it, respected it and dropped and didn't tap into the breakaway gap. Why? Because I said optimally, we don't want to trade into the breakaway gap. We don't. If we're heavy on side, let's rank it into 3 rankings. If we're very heavy on side, like in this case bearish, price won't even touch it. If we're like kind of heavy, we might just barely tap into it and then continue. If we're not heavy or we're just incorrect on bias, price is just going to fill it, probably inverse it and continue the other way. But in this way, we can see how price very nicely just didn't even tap into it and then dropped very, very quickly. So you can identify this, especially in hindsight, that this was 100% a breakaway gap and we were 100% on side. Okay, so now I'm going to go into our third and final example to kind of get this thing, get this idea grounded. I'm gonna take an example from ICT himself, from my notes when I was watching I believe it was the 2023 mentorship. I have a screenshot from his notes, from his videos himself. Okay, so let's go to that right now. All right, final example. This was from ICT's videos himself. This is a screenshot from his videos. We can see here, this is his logo. This is from my notes, the 2023 notes, okay? We can see here if we zoom, this is a consolidation, right? Price isn't impulsing away in any manner, by any means, right? It's just very, very, it's filling in everything. It's not really going anywhere. No gaps, no break of structure, none of that, okay? So what happens is, out of nowhere, at a certain time, we have an impulse away that breaks structure, right? When it broke structure here, let's land this correctly. When it broke structure here, right? If we look, we have 1 gap, 2 gaps, 3 gaps. So Which one is the breakaway gap? It's the first fair value gap after a consolidation that breaks structure. So this movement broke structure. The gap itself doesn't have to break structure, right? But the move it's in has to break structure. Makes sense? So we broke structure here. We have 3 consecutive bearish fair value gaps. Which one is the breakaway gap, which we preferably don't want to see price trade into? It's this one, which I have noted here. It's a breakaway gap. But this fair value gap and this fair value gap, price could very much and very likely tap into, because they're not breakaway gaps. So we can see here how price taps into this gap, but leaves this unfilled because it's a breakaway, and then price continues lower. So that's just basically how to spot a breakaway gap. It's the first fair value gap after consolidation that breaks structure, and it can only be one fair value gap. Optimally, we don't want to see price trade into it. Price is permissible to trade just barely into it, so it's called an institutional order entry drill. But if we're heavy on bias, price won't even tap it, okay? But if it taps, it doesn't mean that it's wrong. It's just maybe a little bit less heavy on the upside or the downside. And if it inverses it or completely disrespects it, then we're just incorrect on bias, right? Which happens. But a breakaway gap, this is basically how it is. Our entries have to be accustomed to them. So let's say in this case, if you wanted to enter here, well, you would have never gotten your entry because, number one, you're being too greedy or too needy. You want the best entry. Number two, this is a breakaway gap. If you don't understand what they are, you're never going to get the entry. Number three, let's just say that price pushed up, like the first example I showed you guys. Price pushed up, or none of the examples I showed you, price tap into it. But let's just assume that price did barely tap into that gap, and it's called an institutional order entry drill. If you don't understand that price could, and it's permissible to trade in the lower half of it, then if you place your stop loss at that bottom of that first fair value gap, which is the 930, which is the breakaway gap, sorry, then you're going to get stopped out, right? You have to include that price, if you're correct, will trade and can trade to the midpoint of that breakaway gap. So your stop loss has to be in the upper quarter to be safe, or just above it completely, right? So that's breakaway gaps. That's going to conclude it for this session. Watch it again if you need to, right? It gets easier with time to identify them. And if you have any questions, feel free to shoot them. And yeah, until next time, guys, stay safe and happy trading.